global ocean shipping lanes are actively constricting. Driven by an 11.1% U.S. tariff rate and a sovereign naval blockade enforced across the Strait of Hormuz, the base layer of the global economy is currently defined by physical friction. The International Monetary Fund has reacted to these constraints by lowering its global growth projection to 3.1%. More critically, the IMF is warning of an adverse scenario where growth compresses further to just 2.5%. The consequences of this supply shock are visible in the Federal Reserve's April Beige Book. It details a stagflationary environment where nationwide employment remains flat, while corporations absorb rapidly escalating energy and utility costs. Futures markets now price in a low 30% probability of a 2026 Federal Reserve rate cut. Any monetary easing is currently tied to the specific timeline of Middle Eastern military de-escalation. Traditional monetary policy cannot resolve a physical shipping blockade. With commodity disruption now a persistent variable, inflation expectations are shifting toward a higher, more volatile floor, leaving traditional safe havens exposed. Against this stagnant macroeconomic backdrop, the artificial intelligence hardware sector is operating in isolation. Taiwan Semiconductor reported a Q1 revenue beat this morning, surging to $35.71 billion. This chart plots TSMC's financial trajectory against the broader Nasdaq. By guiding for 63 to 65% forward gross margins, TSMC proves demand for AI hardware is inelastic to geopolitical energy shocks. This pricing power cascades to downstream partners. Semiconductor packagers like Amkor followed this margin expansion, contributing to a 25% year-to-date sector gain, while the broader technology index remains flat. Software velocity and venture funding have ceased to be the primary limiters for artificial intelligence expansion. Today, growth hits the hard ceiling of thermodynamics and the physical capacity of the electrical grid. Local governments are reacting to this grid strain. The state of Maine recently passed LD 307, banning new data centers requiring 20 megawatts or more of power. 11 other states are currently drafting similar moratoriums. Hyperscalers are adjusting their strategies to meet these power constraints. OpenAI recently withdrew from multi-billion-dollar Stargate data center deployments in Europe to optimize its balance sheet ahead of a targeted $800 billion IPO. To maintain compute capacity, OpenAI now relies on Microsoft's balance sheet. Microsoft is leasing this 230-megawatt facility in Narvik, Norway, through neo-cloud provider Nscale to house 30,000 Rubin GPUs. Institutional capital is aggressively hunting for specialized infrastructure that has already secured local power agreements. FluidStack, a specialized neo-cloud developer, recently entered funding talks at an $18 billion valuation because they hold guaranteed electrical capacity. We see identical behavior in biotech venture capital. Funds are moving away from early-stage platform science to allocate capital toward AI-embedded research and late-stage hard assets, like Aura Cell Therapeutics' recent $110 million raise for its CAR-T therapy. Capital allocators are rotating out of generalized software indices and into specialized physical infrastructure capable of bypassing thermodynamic and regulatory bottlenecks. While the physical infrastructure layer faces power grid constraints, simultaneously, the software layer of decentralized Web3 artificial intelligence is undergoing a massive structural stress test of its own. On April 12th, Covenant AI abruptly disconnected from the Bittensor network, liquidating 37,000 Tau tokens in an instant. This triggered a 26.5% price crash, rippling through the market and forcing over $10 million in long liquidations. The departure was public, with Covenant AI accusing Bittensor's founders of operating decentralization theater. Whistleblower documents supported the claim, revealing that 38 out of 41 network upgrades were executed via centralized infrastructure controlled directly by the founders. Yet this governance failure is occurring alongside surging network utility. Bittensor's Subnet 9 recently published a bandwidth algorithm claiming a 128 times compression rate for cross-GPU training. Enterprise adoption continues regardless of the drama. PwC France is deploying a model on Subnet 44, and the Teutonic subnet is preparing to train a 1 trillion parameter large language model. traditional institutions miscalculated this specific governance risk. Grayscale increased its Tau allocation to 43% of its AI fund shortly before the crash occurred. In response, the Bittensor founders proposed a new locked stake protocol feature. This aims to align incentives by preventing large operators from executing sudden, network destabilizing exits. Institutional investors evaluating decentralized artificial intelligence must price a centralization discount into these governance tokens, decoupling the speculative value of the token from the underlying utility of the network. Legacy corporate accounting introduces a different vector of valuation distortion. On April 9th, Bitmine Immersion Technologies uplisted to the New York Stock Exchange. Bitmine operates a massive corporate treasury strategy, publicly holding 4.875 million Ethereum tokens. This single entity controls 4.04% of the entire global circulating supply. The underlying profitability engine behind this massive digital treasury is structurally significant and operating at an industrial scale. By actively staking over 3.3 million Ethereum through their proprietary Maven platform, the firm generates approximately $310 million in annualized revenue. This split-screen model illustrates a clear accounting paradox. On the left, Bitmine reports a $3.8 billion GAAP impairment loss because spot prices temporarily dipped. Meanwhile, on the right, on-chain staking yields continue to print highly liquid revenue, actively growing an $11.8 billion corporate treasury. To defend against this accounting artifact, Bitmine's management authorized a $4 billion share buyback, creating a floor to bridge the gap between intrinsic net asset value and market perception. Meanwhile, the foundational layer underneath these treasuries is scaling. Ethereum's upcoming Glamsterdam upgrade targets a block gas limit increase from 60 million to over 200 million, vastly expanding transaction capacity. Bitcoin exhibits similar structural maturation. ETFs accumulated over $56 billion. Tether holds a 97,000 Bitcoin reserve, and futures show 46-day negative funding, historically preceding massive short squeezes. Public equity accounting frameworks obscure the extreme profitability of crypto-native balance sheets. For allocators willing to look past distortions, this presents a lucrative net asset value arbitrage opportunity. Naval blockades, power grid constraints, and accounting distortions are introducing a degree of physical and regulatory friction that traditional equity-to-bond correlations were not designed to absorb. This environment necessitates a new wartime portfolio matrix. Analog safe havens are highly exposed to geopolitical headline risk. Gold surged to $5,400 before falling to $4,813 on unconfirmed truce rumors, while Bitcoin maintained structural strength near $74,000. Institutional allocators are observing this divergence and increasingly treating Tier 1 digital assets like Bitcoin and Ethereum as non-sovereign wartime stores of value that remain immune to maritime logistics. Institutional confidence is gaining a formal legal foundation as the SEC and CFTC finalize a joint interpretive framework, providing a standardized taxonomy for digital assets. Concurrently, the Clarity Act is heading to Senate markup. With an 82% market-implied probability of passage, this critical legislation will permanently define the regulatory boundary for digital commodities. This formal shift arrives alongside a leadership transition at the Federal Reserve, marked by the upcoming exit of Chairman Jerome Powell. The nominee to replace him, Kevin Warsh, faces a legal requirement to divest over 30 personal cryptocurrency investments prior to his Senate confirmation hearing. Warsh's forced divestiture creates localized, tactical selling pressure in digital asset markets directly ahead of his May 15th succession, offering a precise entry window for institutional buyers. Generating returns in 2026 requires abandoning traditional quarterly earnings analysis in favor of real-time blockchain tracking and supply chain forensics. Capital must now target 3 specific arbitrages: allocating to physical neoclouds to bypass grid bottlenecks, applying centralization discounts to Web3 governance, and trading the gap distortions that are hidden inside public equity crypto treasuries. In the modern geopolitical tech stack, physical energy limits dictate artificial intelligence pricing, while finalized regulatory frameworks dictate digital asset valuations. Mastering the intersection of these two realities is the only path to capital preservation.